You ever wonder how crypto millionaire insiders are really making money in altcoins? Right now, in the middle of all of this chaos, today I sat down with $2 billion VC partners, the sharpest investors in crypto, to reveal their exact playbook for stacking profits, even as the rest of the markets hesitate. Bitcoin was primed to break out. Alt season was expected to explode, but then the world shifted, and suddenly, everything's up for grabs. So what do you do when headlines can wipe out a year of conviction in a single afternoon?
But if it blows up into a full-on conflict, which is at this point very likely that it blows into a much larger conflict, that could sideline a lot of risk appetite around the world.
That's why today I brought together two of the most influential VCs in the game for a conversation that will change the way you invest in crypto. Haseeb Qureshi, managing partner at Dragonfly, the $2 billion VC firm known for backing crypto future giants before anyone, with early investments in multi-billion-dollar projects like Avalanche, Ethena, Near, and MakerDAO. He went from high-stakes poker to engineering at Airbnb and Earn.com. And now he's the guy founders and investors trust to decode crypto's toughest challenges. And Avichal Garg, co-founder of Electric Capital, the early backers of Coinbase, Solana, and Chainlink. After selling startups to Google and Facebook, Avichal spots foundational crypto plays years before they hit mainstream. This episode goes deep. What they really think about the market chaos, which killer use cases are about to turn the entire game upside down.
That's the killer app for crypto, period.
But it's more than charts and narratives. And just when you think you know how the cycle works, think again.
I don't know if there's going to be a cycle quite in the same way as we've experienced it before.
Everything you thought you knew about timing, conviction, surviving these markets might not be enough this time. But here's the alpha. By the end of this episode, you'll know what the smartest VCs are really doing, how they handle the chaos, what they regret, and the one move they'd make if they had to start from zero today.
I think the easiest, best thing for most people to do is...
You want the full answer? You'll have to watch. This is your front row seat to the ultimate VC fireside. Ladies and gentlemen, my name is Chasse, and if you want to get prepared to catch the next big move, this episode you cannot afford to miss. Without further ado, let's welcome Haseeb and Avichal to the show. Thanks for being here, and we are currently in a very interesting time right now. The markets are reacting to it. But Avichal, is that how I say your name? Avichal?
Dude, that was so good.
Okay, thank you.
Amazing.
Before we hit the record button, we started talking about Polymarkets and how it's looking at and maybe some kind of insider trading, if you will, on the whole Iran-Israel thing happening right now. Maybe
I'll see if I can find the thread. I'll send it over to you guys. But I just scrolled by it right before we hopped on, and basically somebody was noting, and I think it's like the last 3 Israel-related markets have all settled in a particular direction. And they've all started to move something like 12 hours before the market is supposed to settle, basically, in the direction of where it's settling. And so it's, if it's at 30% likelihood that Israel attacks Iran before January 15th or something, it goes from 30% to 80% because somebody goes in and buys up a bunch on one side of the market, and then it closes and they make a bunch of money. So I think they were saying on this wallet, somebody made like 200 grand. And the usage pattern, because you can look on chain, is really interesting, which is it's like a fresh wallet each time. And then it does these sort of like series of buys and then it like withdraws, and it's the only market it participates in. So it's not like that wallet is participating in a bunch of markets. It's like that person is like getting in, like making their 200 grand, getting out. And so the theory that was circulating was there's like an intelligence leak, basically, which, I mean, there's like 300 people or 500 people involved in an operation. Like surely somebody's like brother is listening in or something, right? So even if it's not like anybody in the intelligence, it's like somebody lives with somebody that, overhears the thing, and here you go.
I mean, you could say that, or you could say that it's one way that one side is funding the war.
Mm-hmm. Yeah, I mean, this has always
that's
been
enough to fund. Yeah, that's 200K is not going to fund you anything. And
no, probably not, because the markets aren't deep enough for it. But I mean, like, it helps, right? It might get you a couple drones.
Yeah. Well, I mean, this has always been the concern, and why prediction markets are regulated the way that they are, is they can spill into assassination markets, right? Or they can spill into insider trading markets. And that's why government.
Well, the question though is like, is this a good thing or a bad thing, right? So one of the theories of prediction markets is actually.
Are you saying assassination markets are a good thing?
No, not assassination markets, but I mean this kind of thing where basically intel is leaking through the prediction market, right? The claim is that this is a good thing because the prediction market is giving you more information. Like, why is insider trading bad? Insider trading is bad because, at least in the US, the theory is not that it's unfair. We actually don't care that a market is unfair. If you are Saudi and you know that you're going to be dumping a lot of oil and then you push the oil price down in advance of when you decide to dump the oil, that's actually fine. It's not illegal. There's no regulator that will stop you from doing that because it's understood that that's how commodity markets work, is that, of course, there are people who have control over the market because they own a lot of the commodity. They're allowed to trade just as much as you are. In equities, we don't have that rule, and specifically insider trading in equities is because you are co-opting information that your company is supposed to own. That is the theory under which we go after insider trading. But if the company doesn't have any right to that information over you, then technically there's no illegal insider information or insider trading that is taking place. In this case, like, one could argue that the risk of war is so important to so many people. And the point of a prediction market is to elicit that information. So, quote unquote, insider trading in a prediction market is actually supposed to be the mechanism by which prediction markets give you the truth, is that people who know more about this thing will end up pushing the market price. Like, the more you know, the more you're going to push the market price toward the correct answer. Now, for a war, the way that happens presumably is by somebody who maybe is like committing treason of some kind, right? If you're, part of the Israeli government and you're the one trading this thing, this might be basically leaking information to Iran, and that could be really bad. But it could be somebody in Iran who traded this. It actually could be somebody who's a third party entirely who traded this, right? Could be some weapons provider, could be some drone manufacturer, could be something else completely that's orthogonal, or just somebody who figured it out. Somebody who's just like, hey, I just saw that there's like some weird signals coming up on satellites or something, and it looks like Iran is attacking. And it could be a neutral third party who doesn't care one way or another. So we don't really know. But I think this is prediction markets doing what they're supposed to do.
Yeah. Well, I think the related question is, how does the government think about that? So you're right that that's what prediction markets are supposed to do. And then there's a separate question of like, well, does that make the US government or the Israeli government happy? Which leads to
certainly not. Certainly not. Yeah. Certainly.
So that leads to down to
what I would say is that the U.S. government is certainly not happy because the U.S. government got an advance phone call about this attack, right? So they already had a channel to know about this. But I would imagine that the allies of Iran, or just the people in the vicinity of Iran who maybe didn't know about this, I would imagine they're less excited. So they're more excited, right? So apparently Saudi didn't know that this was happening, or at least that's some of the kind of scattershot reporting, is that Saudi was not given advance notice. They would have loved to know that this is happening, right? So everybody else who's in the vicinity who doesn't get the phone call, for them, I mean, the normalized behavior in the future is that they're all checking the prediction markets. Because the prediction markets is the first place that information is going to leak before it hits the mainstream news.
Yeah, which is fascinating. Kyle, I don't know if this is what you want to talk about. Haseeb and I are old friends.
Yeah, no, I mean, it's
we just ran with it, dude.
Yeah, that's right.
It's very fascinating. I mean, I guess we'll just go into then maybe more what the audience would be interested in is how do you guys see this playing out right now? When the markets are obviously reacting, but I think that's always anything that happens on a geopolitical level, they react. Is this a knee-jerk reaction? Is this enough, let's say it escalates, to counter all the positive momentum we've had from ETFs, institutions, corporate treasuries? It was just, 2 days ago, it was just looking like up only, and there was really a really thick amount of fundamental evidence to back that up. How does this affect things?
Well, so far it's countered 2 days of activity, so it's not sky is falling time yet.
Right.
That being said, I was just I'm looking at the Polymarket front page right now. Polymarket is pricing the likelihood of U.S. military entering into the conflict with Iran right now at 44%.
Whoa, really?
It's spiked within the last few days, yes.
Wow.
So right now, we're kind of on a precipice of, is this going to be a contained tit-for-tat conflict like what we saw several months ago? Or is this going to blow out into a broader regional war? And potentially, if the U.S. enters, then it's not just a regional war. This is potentially on the scale of like a world war.
You know what's crazy, too, is this sort of has this similar shaped curve it started to and it sort of bottomed out on June 8th, and then it started to run up June 10th, and then actually June 11th it really ran up,
Yeah.
Is this what we're looking at right here?
That's what we're looking at. Yeah, exactly.
Yeah,
That's pretty
look
wild.
at that.
Yeah.
So this is what markets are afraid of, right? So like, if, to be clear, it's still more likely than not that this is a contained, we shoot you, you shoot us, and we kind of, exchange blows, and eventually we call it even, or there's some kind of, covert, spy activity that just keeps going on between these two states. But if it blows up into a full-on conflict, which is at this point very likely that it blows into a much larger conflict, that could sideline a lot of risk appetite around the world. It could end up mobilizing a lot of militaries, and ultimately it's a big diversion of energy, of risk, and of capital to go into a conflict of this scale.
Yeah.
So,
also similar, interesting, right? It's like does Iran have a nuke in 2025? It's an illiquid market, so tougher to say on this one, but it does look like it started to move in one direction, like a week ago.
What do you consider? Right. What do you? Yeah, because of the volume, it's $154,000
volume. Yeah.
Right.
Ironically, the reason why the likelihood of the nuke has gone up is probably not because Iran is going to be really incentivized to make a nuke, but rather the evidence that they already have a nuke.
Well, I thought you were going to take that in a different direction, which is this like an Iraq WMD situation where like you could imagine it's like some governments produce evidence that they do, and then other governments are like, wait, that's fabricated information, which is like a whole different.
No, what I was going to say is I think it's very likely Israel has extremely good intel about what's going on in Iran that they're not disclosing. So like the fact that they got attacked probably means that it's more likely in the universe where they actually have a nuke or are very close to getting a nuke that Israel would decide to put on this attack.
Yeah. Same deal. Will Iran close the Strait of Hormuz? Like pumped on June 11th. Yeah.
There was a New York Times article, I think 20 years ago, that said Iran's 5 years away from having a nuke.
Yeah. Yeah. Iran's been a year away from a nuke for 25 years.
Yeah.
That's
so,
right.
I mean, the good chance that they could have had one or could have one.
I mean, probability is still 16% that they have a nuke. So market's not moving that much.
Okay.
Yeah.
And obviously, yes, if you're entering into a conflagration, even if you're close, like this kind of military pressure is going to make it very difficult for them to get any kind of program off the ground now, even still, no matter how far along they are.
Yeah.
So so as an audience watching this, like, is there something that, is there an action that someone, watching this would do right now in these kind of times? Do you think it's a good idea to kind of sideline and maybe exit some of your risk assets, go into dry powder, and what would you guys do if you're managing a liquid? I don't know. You guys both are doing primary markets VC, right? Neither of you manage liquid funds.
No, we do have a lot of liquid assets. So we don't do like trading or anything, but just by the nature of what we invest in, you end up with some liquid assets.
So so are you taking a hedge right now, like, or how would someone play this market?
So first, not financial advice.
Right.
I'd say, I think it's very difficult to forecast where this is going. This is like very, very, right now, look, we're two crypto VCs and we're here talking about geopolitics, like we know something. So, for the most part, I think the fundamentals that undergird crypto, if you actually look back to what happened when Russia invaded Ukraine, you saw a kind of similar thing, which is that immediately crypto sold off. And then within a few days, actually it rallied to even higher than where it was before the invasion. Like it or not, I think generally Bitcoin tends to be a beneficiary of these kinds of geopolitical instability moments. You actually saw the same thing with the dollar, is that traditionally in times like this, dollar rallies, the dollar kind of sputtered immediately after the attack, which is a sign that like, hey, the world is changing in a way that is, again, pointing toward more of this multipolar picture of where the world is going, especially if the US is going to end up being a belligerent in a conflict. That's going to make people even less likely to say, okay, well, the US is where we want to be putting our money. If, we have all this uncertainty right now about deficits. If we're entering into a conflict in the Middle East, deficits are going to just explode. So this is going to make already a concern about the U.S. fiscal situation. That's going to make that accelerate. So I think Bitcoin is ultimately going to be a beneficiary.
Yep.
Alts, that's probably going to be a longer putt until we get some clarity on what is risk appetite going to look like and when does the situation kind of calm down. But that's exactly what happened in the Ukraine war, is that Bitcoin pumped very quickly once the situation was more clear what was going on and people could kind of pick their battles.
The thing I basically agree with all that, and obviously not financial advice, but the thing I would also maybe suggest is short-term trading is just really hard, and it's unclear anybody really has alpha. It sort of feels like you have alpha, but you don't actually. I mean, just look at the Polymarket thing we were talking about. Is just like you're trading against some guy that has like Israeli intelligence information. Like, how could you possibly be on the right side of that? It's just like unless you truly have alpha, you're probably going to be on the losing side. Maybe you get lucky, but so the way I tend to think about it, and this is what I always say, is just like you don't want to be doing these like short-term things. It's a lot easier, I think, to think about things on a long-term time horizon and say like, what does the world look like over the next 2, 5, 10, 20 years? And what are the things that are going to be dramatically different? And what are the things that don't fundamentally change at all? And so like this, what is the Bitcoin price in like a week? I don't know. Is Bitcoin as a non-sovereign store of value that a lot of people have said is better than gold and the institutions are coming into? Does that seem like something that a lot more people will own in 10 years? Probably. Right. And so it's kind of like, could you have picked in 2005 what the big internet companies would be, or how like the market would have moved, and 2008 happens and you get some money printing and yada, yada. That's tough. Could you have predicted that like Amazon is really useful and Google is really useful and probably be way more useful, and do the back of the envelope numbers on like, how many iPhones there will be after the iPhone launch, and figure out what that means for revenue and be like, well, it probably means Apple's worth a lot more in 10 years. That kind of stuff I think is like easier. And so I tend to, we just do long-term stuff. Yeah, it's because it's like too hard to do short-term stuff. And I generally tell people not to worry about the short-term stuff if you have conviction in the long-term. I'm in the
same boat. I definitely don't do short-term trading, and I'm just positioned. And I think that, I'm just positioned. But you guys have been in the space for quite a while. You both have solid background with engineering and building, and I think that helps a lot. How do you fundamentally think that the VC model has changed over the past few years? I mean, there's a lot of people who are calling the VC model dead. I don't personally agree with that, but I think that maybe it's a way that we look at it differently.
Who's calling the VC model dead?
I've seen a few people, mostly people,
random
like
people on Twitter.
Mostly non-VCs.
Exactly.
People talking their book.
Yeah. Okay. And I like that you guys come off with that, that sense of confidence that it's not. I mean, I can't see a world where it would go away. I mean, this is the model's pretty sound fundamentally. But how has it maybe changed with the advent of people bringing AI into the business? People are able to kind of maybe bootstrap a lot more these days. What are you guys looking at?
What do you think, Haseeb?
Did you want to take that?
I can take it. Yeah.
I can go.
The way I think about it is there are a couple dimensions to this. So one, I think there's a definitional question, which is what is VC? And I think one of the challenges with crypto and crypto adjacent sort of investing, which is both, I think, why it's so interesting and also what makes it so challenging, is what it really has done is opened up the capital markets. Like this industry is global in a way that traditional venture capital in Silicon Valley, in San Francisco was not. So like AI, the center of AI is basically San Francisco. This, the center of social media was basically San Francisco. The center of the internet was basically SF. So the Bay Area. And so what that means is anybody can then call themselves a VC. And so there are all these people running around calling themselves venture investors when they're not actually. What they are is people that will like give you money, and then they're very short-term minded, and they're actually traders. Yeah. They've never actually run a business. They've never actually constructed a portfolio. They're not willing to eat a 50% loss ratio where like half your stuff just doesn't work and goes to zero. And so, most people who call themselves VCs are not actually VCs. If you look at it sort of strictly speaking. And I think the purpose that a good tier one proper VC firm functionally offers is three things. One is patient capital. Like we give money to founders and we expect it's going to take many, many, many years. With lots and lots of ups and downs. So I'll give you a concrete example. We're investors in this Solana ecosystem project called Zeta. And they did a V1. They won a Solana hackathon like 4 years ago. We invested. They did a V1. It had like an options DEX that didn't work. They did this like AMM thing on chain. It wasn't performing enough. Now they went back, rebooted. They're doing a CLOB, a central limit order book. They built this network extension to Solana in a very opinionated way about like, should Solana even have the equivalent of like an app chain adjacent to it that writes back to Solana? Took a bunch of opinionated design decisions, and they were like in the wilderness for 4 years. And then in the last week, a bunch of people found them, and they're like, hey, this might actually be really interesting. And so they're just like the center of like the universe right now. That was a 4-year journey, right? And like everybody else bailed, and we didn't. That's the function that we offer functionally, right? It's like we'll actually give you money and stick with you. 2 is proper VCs know actually how to build companies and projects, and there's a lot of machinery that goes into that. There's a lot of expertise that goes alongside that most people don't have because they've never done it. And they don't know all the counterintuitive things that go into it. And then third, this is really I think a correct and wonderful insight from Mark Andreessen, the founder of A16Z, who the Andreessen and Andreessen Horowitz, which is really like what good VCs are doing is they're loaning you their brand. And what they're doing is they're saying, I'm letting you have my brand temporarily until you build your own brand. And that lets you bootstrap a lot of stuff. That lets you acquire customers and partners. That lets you hire. That lets you raise downstream capital. Mm-hmm. And so it's not just the capital, but it's actually the brand that goes with it that you're loaning to the companies. And so you want to be really, really judicious about, as a VC, what that means. Like, what is your brand and how do you loan that out to the right people? And so I would actually assert most people are not doing VC. And so what people think of as VC dies. But what VC actually is serves like a very important market function. It's just that that's not actually what most VCs are doing, quote unquote VCs.
Yeah, the only thing I'd add to that, I think that the death of VC in crypto, I think I've heard people say that VC is dead like every other year for as long as I've been in the space.
The Iran theory.
VC is obviously not dead. I think if you look at what are the reasons why people are now reiterating these calls that VC is dead, I feel like there's a few trends that have emerged recently. One has been the rise of these fair launches within the last few years, things like Hyperliquid and Jupiter. I think a second has been the rise of pump.fun, meme coins, Believe, some of these places where you can just, kind of go directly and memify and go direct to a token launch. And I think the third is the rise of platforms like Echo and now Sonar, of this kind of ICO style investing where you can raise capital directly from retail investors. And each of these three things, I think, are really valuable innovations in capital formation. They've also been around for a while. They're not new. So, syndicates like Echo have been around forever. That's literally what AngelList is. Mm-hmm. And things like, ICOs, of course, I first came into the industry full time when ICOs were at their heyday. And fair launches, Bitcoin is fair launched. Like Bitcoin's the original fair launch. So fair launches also have a very, very long history in crypto. But I don't think that any of these three things are really sufficient to be able to replace what VCs do. And obviously, the vast, vast, vast majority of projects that you know and love and that you use were VC funded. Mm-hmm. So that includes, it includes Solana, it includes Circle, it includes Coinbase, it includes, think of almost every single product, even pump.fun is VC backed. Now you look at something like, if you take, for example, the fair launch projects, right? So like Hyperliquid and Jupiter, they're notable for being some of the big winners of this cycle, but they're also notable because of the fact that their founders were very wealthy, and they were able to self-fund their projects to the tune of millions of dollars, which the vast majority of founders just cannot do. They don't have that kind of money, and so if you actually want to get, to scale pre-TGE before you have your token, right, the only way you can do that is to raise money from VCs. Now there is the route of going to something like Echo or Sonar, and there was a great thread recently by Mosi Vanacharmer talking about how there were some people who were investors in something on Echo, and this guy started complaining of like, oh my God, I agreed to this lockup and the lockup got pushed back. What a scandal. How can these guys do this to me? It's like, dude, this happens to us like every day, like, every other deal. Yeah. The terms.
Yeah, it happens more often than it doesn't happen. The terms are usually changed.
Exactly. And so and people realize like, oh wait, if you go look at the track record of projects that have been syndicated on Echo, a huge number of them are failures. Which of course that's normal. That's totally normal. It's not a pockmark against Echo. That's what VC investing looks like. So if you're not comfortable with that, which most people are not, do not intuit that that's what the economics of VC investing are like, because they think about bull markets, right? And yes, in bull markets it looks like everything is going up, right. But if you're part of the initial syndicate, you're doing the seed round, you're the last to get out. Yep. You don't get to experience the pop that happens on day one or week one or year one, right? Like if you get early into something and it does like this, okay, this is the part where you get your liquidity. Yeah. So being a VC is hard. I've been in the VC for a long time. Most VCs I know died. Most VCs I know did not make it. They did not get to raise the next vintage. They don't remain at the top of the mountain. And the reason why is that it's really difficult. And most people do not succeed at it. So now it's not to toot our own horns. Like I think in all these varieties of ways in which projects can get access to capital is good. We want projects and entrepreneurs to have access to capital and of as many forms as they can take it. But the forms that VC takes, which Avichal laid out, the things that we do for founders and for teams, it's always existed. It's as old as the tech industry, and it's not going to go away. But it may end up serving more particularized niches than it has in the past.
Avichal, you said that one of the main things is lending the founders the brand, and so one, you have to be that's something that one, you guys are doing scrutinous due diligence to make sure you protect your investor. I think you guys both run LP funds, right?
Mm-hmm.
Yeah. So protect your LP's money, but also protect that brand. If you're lending it out to people, that needs to be a valuable brand that, make sure that you invest in quality things. One of the things that when I was much younger, I was always kind of this guy who wanted to build stuff from after high school but like, I didn't know how to go to VCs to raise money. And I have, a lot of people on my channel, I encourage them to try and go build something or go do something because you don't want to do a 9 to 5, and what is the best way for people to come and to a very respected VC like both of you guys run and pitch, and what are you guys looking for?
So I'd say generally there's 3 ways to get in front of VC. The first and the best for you is that they find you, which is you're putting out so much content, you're building your brand, you're getting people to talk about you, and that's going to bring, like, all of our investment team is constantly out there, kind of spelunking, right? They're out hunting for the next awesome deal. And when we see somebody making a lot of noise and getting a lot of attention, we reach out to them. So that happens all the time, and that's the best way for us to get in touch with you. The second way is to get in through some kind of reference. So whether it's a founder who's previously worked with us or somebody who's connected to us in some way, somebody who we worked with in the past and we know has a strong reputation, that is going to give you a much better path to get in, where you come in warm, you come in highly regarded by somebody in our network. Coming in through the front door, like if you just go to the website and type in the email and you say, "Hey, hi, I'm da 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 da," very, very that's the least likely way that you're actually going to get in front of a VC. So, technically that door is there, and occasionally we end up investing in things that come in through the front door. But the reality is that you're a founder. Like, your job is to be enterprising. Your job is to be creative. Right. And for a top tier VC, very seldom is the way that you're going to get on their radar, and for them to seriously consider you as an investment, is going to be through writing a cold email. Yeah,
nothing to add there. I mean, I sort of think of it as like, do interesting things, like build and ship something interesting, and the world is connected enough that sort of, will stand on its own. Know interesting people. So if you know really, really smart, accomplished, successful people, especially founders, then you get in through that. Or say interesting things. So, like, you can do that on Twitter. You can also do that by emailing us. But, if you can articulate what you believe in a way that cuts through the noise, then you have a shot. And to Haseeb's point, like, being able to do interesting, novel things, being able to find your way to the smartest, most accomplished people, and knowing how to communicate effectively are the core skills of a founder anyway. So if you can't do those things to get to us, then you're probably not going to be successful as a founder.
Where do you guys see the space evolving or going to right now? I mean, we have like sufficient, I think so. Anyway, we've got sufficient layer 1s, and for Ethereum, we've got layer 2s, and that space is, I mean, they're good, right? Like, Solana is great. Sui and Aptos are really good. I mean, they were, R&D from Zuckerberg, and, a lot of money put into those, and they're great. They're fast, they're cheap, scalable. And I feel like we're pretty good there. Do you think that, where do you guys think we are? And do you see any evolving trends that, the next kind of trend that's evolving?
I think there's a bunch. I don't think we're done with the infrastructure layer. I do think infrastructure has been overinvested in relatively narrowly, but infrastructure is one of these things where it's you build infrastructure and then people build apps and they soak up all the capacity on the infrastructure, and so you need new infrastructure. That's why computers are slower than they were 10 years ago, even though they're like 1,000 times or 1,000,000 times more powerful, or why the internet is always not fast enough, right? So we'll soak up soak up capacity. Jevons paradox, if anybody wants to go look that up. So, infrastructure is always interesting. You just need to be able to articulate why the next gen infrastructure is going to look a certain way. Mm-hmm. I do think the market has been under indexed on applications in part because of regulatory, and infrastructure having a path to being considered a token network that is a commodity made it so that it was an easier path to go raise money around infrastructure, and the market understood it. I think with US regulatory changing, I think we're going to see an explosion now at the app layer. Cool. We've always held that the most interesting things I sort of have this 3Cs mental model for crypto, which is there's the casino, there's the capital markets, and then there's the computer. And the casino is all the speculative stuff, and it bootstraps the capital markets because it brings billions and billions of dollars in. And out of that, you get really interesting and useful things like perps, options markets, AMMs. But what you're really getting is like financial plumbing and tooling. And then eventually, once you have enough of the capital markets established, I think you'll get real computational infrastructure that starts to emerge, because you need computational infrastructure that can operate at a global financial scale. And that sort of necessitates building distributed systems and computational infrastructure that can scale. So we've always thought about kind of the 3Cs. And we think we're kind of in the middle now, where the really interesting things are actually the capital markets pieces. And so things that are novel ways to aggregate capital, things that are novel ways to aggregate liquidity, things that tools that make it easy for anybody in the world to participate in capital markets, and some of those will look like traditional things. It might be like we're investors in a reinsurance company. Reinsurance is this like really in the weeds thing of insurance for insurance companies, and so they take all their insurance policies and bundle them and resell them to a reinsurer, or sort of get insurance on their insurance policies, paying out in a certain way. It's a huge business. There's like $50 billion companies in that market that people don't understand. And with on-chain capital markets and stable coins, all of a sudden you can build a new kind of reinsurer and bootstrap the capital markets function inside that business in a totally different way. So some of it will look familiar, but with like a different backend. We call those mullets, fintech mullets, where it's a regulated fintech business on the front end, but crypto on the back end. But some of them will just be brand new things, like perps and AMMs are these sort of like novel constructions in crypto that are actually quite useful, and they will sort of eat up and subsume traditional markets in all sorts of ways. So that's where we're focused right now, and I think we're just starting to see the beginnings. And a lot of those will be end user facing. Those are like mobile apps you can build. Those are web apps you can build. Those are pieces of infrastructure that get ported into brokerages and Coinbase and Robinhood, and that's global. And I think we're just starting to see the beginnings of the computer stuff. So things like Walrus, which is a decentralized storage protocol coming out of the Sui Foundation, which we were investors in, both in Sui and in Walrus. So you're now, I think, starting to get to a point where some of this distributed infrastructure might actually be performant and be interesting. But it's still early there. So yeah, we're especially right now, I think, focused on sort of like fintech and fintech applications around the capital markets. I also think we're just at the beginning of starting to see some really interesting social stuff. These are in effect, the casino is in effect a way to think about it as like real money games. It's really a gaming platform. And people just happen to be playing games with real money. And games are inherently social. And so I think there's a lot of really interesting social experimentation happening that we're sort of paying attention to. And social is interesting because it's just, it's a little bit of a random walk. You need a couple of thousand young founders poking around, and then somebody stumbles into a thing that is actually a brilliant insight. And so we are paying attention to that. It's just really hard to predict what's going to work there. Whereas on the fintech side, it's a little bit more of a straight shot. Like you can look at markets and say, like, here are the things that have historically worked, and so we can go after those opportunities. But we're actually pretty excited to hear from founders that are working on social stuff, because I think somebody's going to stumble into something big there.
Can you give me any examples of it? Because when I think of social, I think of things that like X, for example. These things have massive network effect, and as a YouTube creator, it's like, okay, yeah, well, Rumble comes along, but I'm going to make content and I'm going to put it on the place where the biggest audience exists. Yeah. Things like BitClout came along, tried to do that. Really, really nice infrastructure. The first ones I saw that did like really good account abstraction. They had a huge war chest. It didn't work out. They built a whole layer one for social. So what are some other examples that maybe I'm not seeing of where this could evolve? Yeah,
well, I actually, there's a bunch. Let me just throw a couple out there. I see. I'm kind of curious at what other ones you would have. I mean, I would argue Polymarket is effectively a social experience. Like you're playing sort of like a real money betting experience in this like virtual casino, and a lot of it is like small dollar markets. Maybe you win $50 or $100, but it's like really the social clout that you're getting. Mm-hmm. That's a huge part of it. I think the NFT PFP boom was actually a social behavior. It's a like you look at something like Azuki's, and I think there's a real community there. Like they just love the art. They go off and create art adjacent products with it to reuse their art and doing really interesting things. And I think the whole idea around something like punks, it's really a social exercise, right? What are we doing? Like humans as primates, as social primates, we have a need to signal to each other. So we need to socially signal fitness, right? So what we're really saying is like, hey, look at all my excess resources. The fact that I can like own this thing that's worth a lot of money. This is, if you look at something like LVMH, right? Like I think that company is like the second or third largest, richest person in the world behind Elon and Zuck maybe. Like what do they really sell as a company? What they really sell is they have a machine that takes your capital and converts it into social capital. That's what these like brand businesses do basically, which was exposed with like the China tariff stuff, right? It's like actually all getting made in China, and then they like slap their logo on it, right? And so what they're really selling is their brand, right? And it's a transformation of capital into social capital, because if you carry around a Birkin bag, what you're really doing is saying, I have so much excess capital. You should know me. You should hang out with me. You should trust me. And that's just a social primate behavior, but it's actually fundamentally a social behavior. And that's what PFPs and NFTs were. I think some of the new and interesting stuff that people are playing with, like I think time fun on Solana side, super interesting. Like, can people sell their time? This is sort of like a reboot of the earn experience from, what was it, 17, Haseeb? When was that? It's like 16, 17.
The Axie stuff.
That's right.
They're playing with this idea of creator-owned communities, and can you actually create a purpose-built like Discord or Telegram sort of an experience where a community can come and you have the crypto infrastructure which allows the community to really fundamentally own the message and the messaging service, and they could run it on their own infrastructure. And that allows a creator to set a bunch of rules and smart contracts about who can and can't be there, like how many members are there allowed to be, and you can actually enforce that cryptographically. People could buy and sell memberships. Mm-hmm. You could pool capital because you could have a shared wallet at the group level. So there's sort of like a lot of primitives there that sort of potentially open up really interesting behaviors for social interaction. So people are playing around. Like, I don't think any of these things is necessarily, other than Polymarket and arguably some of the PFP communities, I don't think have really sort of taken off, but we're watching stuff like Time Fun and Towns. There's a bunch of people sort of playing with it.
Yeah. So there's a term that I've come to appreciate, which is financial entertainment. And I think a lot of what really works in crypto is this kind of financial entertainment. And I think within financial entertainment, there's really two poles. If you think about Avichal was describing Polymarket as social. Actually, I don't think Polymarket is very social, but I think pump.fun is extremely social, right? Now, why is this true? Polymarket, you don't really care who else is trading this market. And if anything, there's some places where people will brag about their Polymarket P&L, but it's actually pretty hard to find. For the most part, people are talking about the markets, right? So we were just talking about a Polymarket market. None of us have a trade in this Polymarket market, right? But we're all talking about it because it's eliciting information that itself creates a conversation. But the vast majority of people in the conversation don't have a stake in the actual market. Pump.fun is the opposite, is that nobody would ever talk about some random fucking meme coin on pump.fun. But everybody who's in that meme coin is talking about it. Right. And in fact, the game is really talking about the meme coin. And by talking about the meme coin is how the meme coin wins. But you and I talking about, the Iran conflict is not going to move this market at all. Right. Maybe tangentially if we're famous enough and we draw attention to the market or something. But the reality is that there's an external reality constructing how this market's going to be priced. And so we're kind of playing largely a single player game that has much larger social consequences when we're trading on Polymarket. But all the people participating in that conversation are not actually playing the financial game. Whereas in pump.fun, nobody is talking about what's happening on pump.fun except people who trade on pump.fun, right? Nobody would ever talk about any random meme coin there. So it is in that sense, what's happening on pump.fun is hyper social. And it's more akin to what's happening in the NFT world, in that you become a part of this community, you're galvanizing other people, and part of the game is making the circle of people who talk about this thing bigger, and that's how you win the game. Whereas in Polymarket, like the reason why it's compelling is because it is a meaningful way to express your financial beliefs about the things you're reading in the Wall Street Journal or in the New York Times. But it's a way to play the game with the world, or to play the game with the media, and to feel like it's more like betting on sports, where it's more it makes you feel a lot more drawn to the game, like invested in the game. Where normally you might be like, look, this is I don't care about either of these sports teams. This is just some random playoffs game. But suddenly you have $100 riding on it, and you suddenly really, really care about what's going on in this game. It heightens the experience for a lot of people, which is why they enjoy sports betting. The same thing I think is kind of what Polymarket does to the real world, but again, it's not you're not directly betting against the guy next to you. As you're watching, what's happening in the Iranian conflict. And of course, the Iranian conflict is a uniquely macabre thing to be thinking about, like sports betting. But when people bet on elections, when they bet on, is the interest rate going to go up or down, or is Trump going to say this thing in his next speech, or is he going to use this word or that word? That's a lot of what it ends up doing is transforming people's experiences of politics, or transforming their experience of just watching, a normal news conference. All of a sudden, something that is kind of boring and repetitive suddenly becomes a game. And so this way of financially gamifying different parts of the world, I think this is what crypto is really good at from a consumer perspective. But there's different ways of expressing that game that appeals to different kinds of people.
We haven't had a kind of killer app or use case yet in this industry. I was watching over the weekend, I watched this really, really fun little thing on Netflix. It was called Super Pump. It was the story of Uber. I don't know if you guys have seen that, but it was just interesting to watch, someone create such a disruptive product that literally changed, how we get around transport. And that was something that was obviously massively disruptive to the way that we had, done public transportation or semi-private transportation for a long time. We haven't seen something like that. I mean, the most that we have right now, even in crypto, is maybe a few 100,000 wallets active a day on one of the chains. Whether it's Solana or Sui or Avalanche or whatever. What do you guys?
I totally disagree with this framing. Yeah, I completely disagree with.
Yeah, I disagree with the premise actually. You go first, Steve.
Okay. So first of all, it's not hundreds of thousands of people on chain. We're in the millions of people on chain. Just Solana is like, what is it, 6-7 million daily active addresses, and then that's not counting all the EVM chains, which gets you into probably on the order of 20-30 million daily active addresses that are acting on chain
per chain. But yeah, you're right. Okay.
Yeah.
Near is up there too. Near's in the 6.
Yeah, Near's in several million. So I think in aggregate, you're probably on the order of about 20-30 million across all chains. Now that being said, what do we mean by killer app? So killer app is obviously a term of art that comes from Web 2. And I think when people think killer app, they think literally an app they install on their phone. In which case, if that's the context in which you're thinking of killer app, it's it's supposed to be like Farcaster or something. It's supposed to be the killer app. And if it's not shaped like that, we don't identify it as a killer app. I think this is kind of missing the forest for the trees, is that we didn't know whether or not there was going to be a consumer application that looked like a Web 2 type app that was going to be the killer use case for crypto. But the killer use case for crypto has been around forever, okay? Which is finance. That's the killer app for crypto, period. And full stop. We've known it for a decade, right? So in what way is that true? I mean, I could recount all the stats about stablecoins. We went from, when I first got in this industry, we had a few $100 million worth of stablecoins. We now have $250 billion of stablecoins. We are now, what was something like 2% of M2 is just stablecoins, which we went from, basically a single basis point when I first came into this industry. We went from 140 billion to 250 billion in the last, since the beginning of 2024. Okay, the crypto stablecoins now do about as much volume as Visa. This is an absolutely massive part of the market. We have, I believe, as of 2024, beginning of 2024, if you aggregated the total number of accounts that own stablecoins of at least $10 of stablecoins, it would be about as large as the 5th largest U.S. bank. Okay. A lot of people around the world own stablecoins. It is huge. It is only going to continue to grow. People are talking about $2 trillion. Actually, I think it was by 2029. I think Besant was basically in Congress saying that he thought it was very plausible that we'd get to 6 trillion by 2029. Okay, that is insane. That's basically M0. M0 is 6 trillion. So stablecoins are, if you're gonna name one specific thing, stablecoins very clearly are a killer app.
Yes.
But I think it's not exhaustive of what would qualify as a killer app within crypto. But I'll stop there. I'll let Avichal pile on.
Yeah, I think another way to say it maybe is, I think it comes down to what your definition of killer app is. And I think those of us who are fortunate to live in like functioning democratic, for some definition of democratic, capitalist countries, like the US and Singapore and Western Europe, we have the luxury of having working financial systems. And really the first 2 or 3 killer apps that have emerged for crypto, I would argue, are one, a non-sovereign store of value in the form of Bitcoin and a prospective store of value in the form of ETH. 2 is stable coins, like Haseeb was saying. And 3 is essentially exchanges, right? Which is like the ability to trade stuff. And so when you look at those 3 things, those are all actually end user things. Like a lot of the world doesn't have a stable currency. They're kind of, if you're in Latin America, let's say you're 40 years old in Latin America, in Argentina or Brazil, like you've seen a currency crisis, your currency is imploded 2-3 times in your life, right? So it happens like every 10 to 15 years. And so, you need something like gold or Bitcoin. Most of the world has relatively high inflation relative to the US dollar. No matter what you think of the US fiscal situation or, money printing, the reality is that the US dollar is the unit of account for the world, and goods and services denominated in dollars. So if you're in Nigeria or Vietnam or Turkey or Lebanon, like you would love to have dollars, which is why stable coins are so, overseas heavy, right? And that's an end user product. And it's a retail product. Like that's actually, it's not the central banks that are buying, it's people. Right. So when I look at those kinds of things, I think those are actually killer apps that are end user killer apps on your phone. It's just that those of us in the West don't have to deal with that pain as much, so we don't experience it as directly.
I guess, so I don't disagree with anything you guys said. I guess let me reframe it, because I come from a more purist perspective. I've been around since 2012, and I really like the idea of decentralization. And then when smart contracts came into the picture, I thought, oh, this is so cool. You can build the most efficient systems, remove the middleman, peer-to-peer transactions. And I think like the oldest, best example I always give of people when I try to explain what a DApp is, of say like, well, imagine Uber, and but you just didn't have the company that you had to pay and that extracting that value from the middle. And so I guess that's the frame I was more taking, is like, are we going to build these dApps that remove middlemen, that allow peer-to-peer transactions to happen, to make more efficient systems possible, to where in the future someone's taking Duber, right, their decentralized Uber app to the airport instead of actual Uber, because you can't. I think it's really hard for an incumbent to pivot their business model to compete with someone who doesn't have to extract that fee from the middle.
Well, I think this is really so the key, I think, is sort of like keying on these definitions, right? So I think the Uber example is an interesting one. Like I actually think that's not the right way to think about it, because this infrastructure lets you do different things. Like the internet infrastructure, Web 2 mobile infrastructure, was optimized given the constraints of the technology. We had GPS, we had real-time messaging, we had information, packets that could flow. Here, this stuff is really good at moving money. So I actually look at things like Uniswap, right, as an AMM that unlocks long tail markets and capital formation, or things like Echo, or the ability for founders to raise money no matter where they are in the world with smart contract or perps. Like these are all actually like very interesting breakthroughs. The analogy, I think the way to think about it maybe in like Web 2 land is, I think for a long time, I worked at Google and Facebook. For a long time, people didn't think about social media as a form of news and information discovery, and that's actually how news and information would flow. They said, like, wait a second, like, what is the on-chain New York Times or the on-chain CNN? And you had things like, TechCrunch, or you had, like these media companies on chain that were writing blogs, when really the next gen media companies were Facebook and Twitter and YouTube, right? They were these things that natively took advantage of the platform and solved the same human need, but in a fundamentally different way. And so I think it's unlikely anytime soon that we get things like, the decentralized Uber or something like that. I think it's just that this infrastructure is good at a totally different set of things. Yeah. And so we should look at the things that it's like uniquely good at and what human problems it solves. And I think a lot of the things that it solves in the short term are sort of these capital formation sorts of problems. And so the way most of the world will experience it will be through financial products. And what's interesting is like the internet didn't really revolutionize financial products, right? It's like, what are the apps that you have on your phone? It's like your Bank of America app or whatever, right? It's just like you took like the same shitty 1970s infrastructure and just like put a mobile interface on it. And even that took them 20 years. And so we haven't seen like a true transformation of what that looks like. And so I think that's actually where this stuff will take root. I think if you look at something like Base from Coinbase, It's like pretty fascinating. Like the Coinbase self-custodial experience has gotten like pretty decent, or like MCP infrastructure for institutions to control assets is like, if you look at Anchorage, which we're investors in Anchorage as a custodian, that's actually how a bank should work, right? And so, I think we're going to see. I don't think we see Uber anytime soon. I think we just see an entirely new class of applications that solve real problems for people that are native to what this infrastructure is good at.
One thing I would add is that, I remember hearing a lot of these stories in 2017, 2018 about, okay, we're going to rebuild Uber on the blockchain. We're going to rebuild Airbnb on the blockchain. We're going to do it in a decentralized way with no customer support team, no middlemen, no routers, none of that stuff, like no org chart. It's just all going to be smart contracts. And obviously every single one of these things failed, right? None of these things went anywhere. And the question you might want to ask yourself is, okay, why? Why did all these things not work? One answer to that could be that, like, well, crypto doesn't have a killer app and crypto just sucks and it's like bad technology, it's slow. I think, maybe those are partly true, but I don't think that's really the reason why. I don't think it's not true. Reason why. It's not true, yeah. But I don't think it's the reason why these things failed.
Yeah.
I think the reason why these things failed is that in reality, Uber is actually just like fucking great. I think that's the reason why this failed, is that Uber is just like really fucking good and they actually don't make that much money. So there's not that much fat to cut, right? Like the reason why we didn't create decentralized Facebook is not because you can't create decentralized Facebook, is because Facebook is really fucking good. People like Facebook. People actually, like, they say they don't like Facebook, but they actually fucking love Facebook. And this is true for the vast majority of Web 2 apps, is that, like, because they loom very large in our minds. We fixate on, like, oh, what would it take to disrupt them? But the reality is that these are extremely well capitalized businesses with huge network effects, with some of the smartest people in the world who continue to iterate and copy each other and rip off each other's features. And like they're at the forefront of innovating every single day. And crypto, like blockchain technology, has its own superpowers, but it gets those superpowers at a very severe cost. Which is, it's like it has to tie one hand behind its back, but as a result, it can fly. Okay, that's kind of what we're like. But we're not going to win in a bar fight against like the strongest dude in the bar, which is Facebook, or Uber. We're just never going to do that because they're just too good. Now the reality is that we can beat a lot of people. Like, for example, the banks. Yeah, the banks suck. They're slow. They're not innovative. They don't have the smartest people. They're as Avichal was saying, they're basically untouched since the advent of the internet. Nothing has really changed about the Chase banking experience, except now I can visit my bank account through my phone. But if anything ever goes wrong, I have to go into a bank branch. Right? That's really the experience. And from that to creating a version of that exists entirely digitally, completely intermediated by smart contracts and code that can be edited by anybody and is completely permissionless, that's totally different. Yeah. That actually is new and innovative, and we can win that fight. So that to me, that's the reason why. I've largely abandoned the story that, okay, we're going to replace all these Web 2 services, because they're actually just really good.
They are really.
It's hard to beat them even if you're decentralized.
So I know that you're both focused on long term. Like that's your whole business model is, stick around for a long time, look at that 5 to 10 year horizon. But you guys are both very smart, and my audience would like to hear your opinion on, where do you think that we are in this market cycle? Do you think that we're following a traditional 4-year cycle, or do you think that's been broken and now we're maybe pushing out to an extended kind of a new world we're living in these days?
Avichal, where are we in the cycle?
I don't know. Short answer is I don't know. The reason I don't know, there's like a naive answer. You can put some 4-year things on a chart and like draw some lines and some fib retracements and stuff. Yeah. The thing is that like markets are just a collection of market participants, namely humans and institutions, making some set of decisions. And pattern matching breaks when the market structure has changed. Yeah. Right. And so you saw this like with the bond market, for example. Like it was sort of like from the 80s, it was like, we're just going to cut rates, and then it sort of broke right at some point, and that's just not true anymore. So rates are higher than they were. And that's sort of like a historical first, right? And so the thing you always have to be thinking about is actually, is the market structure the same, or has the market structure changed? And I think the market structure has actually changed with the advent of ETFs and the advent of BlackRock pushing this stuff, and the advent of central bank, like the fact that The U.S. has a Bitcoin reserve, and the government of Pakistan has a Bitcoin reserve, and the Kingdom of Bhutan has bought some Bitcoin. And Wall Street is talking about like tokenizing bonds on Ethereum, and it's just like the market structure and the market participants are meaningfully different from what they were in the prior cycles. And what that means is that the market participants there's no guarantee, but they may behave fundamentally differently. Mm-hmm. And I don't know if that's true or not. And so I don't know if there's going to be a cycle quite in the same ways we've experienced it before. So for example, a lot of people naively would say Bitcoin runs, then ETH runs, then the alts run, as you sort of get this like sort of increasing risk on behavior. But, like we've never had rates this high during a cycle. We've never had a recession during a crypto cycle. We've never had the Fed not willing to cut rates and print more money. And we've never had this many institutions. We've never had retirement accounts pouring money into stuff. And so just like the market structure has changed. So I don't know the answer to that question, which is, again, why I go back to the like, I think the easiest, best thing for most people to do is just think about what's the same in 10 years and what's fundamentally different in 10 years. And if you have good answers to those two questions, you can probably figure out what a reasonable allocation of capital could be. And I think that's much easier than knowing what happens, I think, over the next 12 months.
Well, so I do know what happens over the next 12 months, which is
please do tell. Well, I actually to give Haseeb credit. Haseeb called the top of the last market. I remember having a conversation with him.
Yeah,
it was like 4 or 5 years ago, and we were talking about where we think the top's going to be, and he and I had a conversation. We had conversations inside our firms about this stuff, and Haseeb nailed it. They were exiting as the market was basically going into the top. I don't know if you guys top ticked it, but that was
there were two peaks, and we got the second peak.
Yeah.
Here's what I would say is that I think everything Avichal said is true. Is that market structure is changing, and I think the more that people talk themselves into this idea that the market is changing, the more I think the 4-year cycle is going to entrench. Is that like this idea that like, well, everything has changed, and like now because we have ETFs, and I mean, if you look at the ETFs, the reality is the ETFs are still mostly retail, right? Like the ETFs are about 30% owned by institutions, which means 70% of the flows at the margin are actually just same old retail. They're just doing it for a brokerage account instead of going on Coinbase or Binance or whatever. So I think, and it's even more true for Ethereum. So if you look at Ethereum, and especially if you look at something like Solana, if Solana ends up having an ETF, it's probably going to be very, very retail dominated. So I think the reality is that this is still, although there are institutional flows that are increasingly coming in, and there's wealth managers, and Morgan Stanley, and all these folks are now trying to get their high net worth clients to come into the space. That's always been true. There's always been high net worths and family offices coming into the space and pricing it. And human fear and greed is not subject to, okay, you're this big, therefore you're not going to be greedy or fearful. If anything, like because of the nature of this asset, you might be even more greedy and even more fearful than you would otherwise be as an institution, because of the kind of the geopolitical valence of something like a Bitcoin or an Ethereum. So my base case is that probably things won't change. Probably we're still going to be cyclical as hell. Probably there's still going to be Bitcoin cycle, alt cycle. And I think the fact that people are really convinced that it has changed is, to me, evidence that it probably is going to continue until those people kind of get kicked in the stomach and give up trying to prognosticate about it.
Do you think that the American markets might play a role into that, and is something maybe structurally much different with the clarity coming through this legislative bills, where we have, finally for the first time, you have the biggest market in the world now participating with clarity and coming in, especially when it comes down to builders and people building the United States, capital raising in the United States, deploying in the United States, selling to Americans. Do you think there's going to, like, that as a structurally different thing enough to maybe skew that a bit?
Well, look, for VCs, that matters to us a lot because we spend all of our time funding people who are at the very beginning of their journey and building something. And for them, that clarity really, really matters. Mm-hmm. But if you're talking about crypto markets and crypto market cycles, you can buy Bitcoin and Ether ETFs, and pretty soon you're gonna be able to buy SOL ETFs. You don't need legislation for that. You can go on Coinbase and buy any of these. You don't need legislation for that. Even if no legislation passes, Coinbase is gonna be open for business for at least the next 4 years, right? So this stuff is ultimately very good for the industry going forward. But most of the market is like 10 assets. And those 10 assets are already accessible to retail investors. So I don't know that is going to be the reason why people are going to allocate to Bitcoin or allocate to Ethereum. Bitcoin and Ethereum very clearly are already in the promised land of, these are commodities that are beyond the reach of any securities regulator. So for the rest of these assets, having a clear regulatory path is very important. But is that going to change whether people are greedy or fearful, or whether there's going to be cyclicality to these assets, or whether people are going to get over exuberant, or they're going to get ahead of their skis? I mean, look, we just saw Circle go out. Circle, obviously a great company, incredible leadership. They're trading at 160x earnings, right? And you're telling me that, okay, well, now that we have institutions, the market is rational? I'm like, no, I reject the premise.
I had this very funny visual when you said that, when we were just talking about the fact that these people buying these things are still human and still live off the fear and greed, because we've got about 60, 70 publicly traded companies, I think, that are now establishing Bitcoin treasuries. And, if they were trained or if they were indoctrinated by Saylor, you would think that they have this like real long-term diamond-handed kind of mentality. But I just, when you said that, I just quickly imagined 80% of these corporate treasuries, as soon as the price of Bitcoin falls 15%, just going, holy shit, and selling their bags and be like, we made a mistake. That is the same kind of.
Okay, that I don't think is likely. I think there's two categories, right? There's companies that have put some Bitcoin on their balance sheet. So think like Nexon, which is this gaming company for Korea that bought a bunch of Bitcoin, versus something like Metaplanet or obviously SBET or something, where they've gone all in on we are now a financial engineering play. That is what this company is. If that's what you are, you ride or die with your asset, right? You can't, if you pivot, it's over, right? There's no coming back to running a normal business again. Whereas for some of these people who have Bitcoin on the balance sheet, I mean, it's a relatively small part of the overall corporate crypto complex, is like these guys who bought, $20 million or $50 million of Bitcoin. These are not the main movers in the market. It's the big treasury plays that are really substantial, and I don't think those are going to, come back from the precipice at this point.
One thing I agree with that, by the way. I think the treasury companies are sort of in a unique category, and they're going to ride the wave. Yeah. One thing I'll say, I think on the Circle stuff, and for full disclosure, we were one of the launch partners on SBET, which was Joe Lubin's ETH treasury offering. And so, we've obviously thought about this a lot. Just to maybe clarify this, like institutional market structure thing has changed. I'm not saying that institutions are rational. I don't think they are. And this was actually one of my biggest learnings as an investor over the last several years. Is I used to think that individual humans would be irrational and groups of humans could come together and be far more rational. And what I've learned is that they're just differently irrational. They're still irrational, just in different ways. And so you get these sort of emergent behaviors out of groups that make them differently irrational. And so I don't think it's necessarily that the institutions will be rational and therefore we won't have cycles or the same cycles. I think it's that they could be differently irrational. And therefore the irrationality expressing itself in a different way means that the cycle gets expressed in a different way. And actually the Circle thing might be an example of that, right? So it might be that like the cyclicality and the sort of like the exuberance gets expressed not in this like long tail alt market, but it actually gets expressed on the US public equities market. Right. And so it's like you still have like a boom and a bust, but the alts are actually these like companies on like the NASDAQ, right? Which would be a way different way to get that expressed. So that's more what I'm saying. It's not that they're rational, it's just that they're differently irrational.
Right.
Okay, Haseeb, since you called the top last time, where's the top?
Dude, tell me.
We're not there yet. We're not there. I'll let you know. I will call into the show first thing.
Okay.
And I decide we're at the top, but we're definitely not at the top right now.
Well, I mean, I think if you're playing something similar to last cycle, then we maybe get this this quarter four type of parabolic run.
That's you talking. I'm not thinking about Q4.
All right, guys. Thank you guys both so much for coming on. Really interesting conversation. I think people learn a lot. You guys both have a ton of experience. I'd love to get you back on again in the future. But thank you.
Thanks for having us.
Good to see you.